Hey everyone, welcome back to the Gold TLDR. Today's video is absolutely critical. If you're holding gold or silver, or if you're thinking about taking that year-end bonus and diving into the market, you need to watch this till the very end. Just before Christmas Eve, international gold prices smashed right through the $4,500 psychological barrier, hitting an all-time high of $4,525. This isn't just a Santa rally, this is a Santa Godzilla. If you've been holding gold since the start of the year, congratulations, your assets are up nearly 70%. It's the wildest year since 1979. Silver is even crazier, blasting past $71 and doubling in value. But, did you notice something? Just when the hype was at its peak, gold hit that $4,525 mark and slammed into an invisible wall. It pulled back to stop around $4,480 before the holiday close, and now that markets have reopened after Christmas, we're back above $4,500. The entire market is asking the same question right now. Is this Christmas gold party coming to an end, or is this just the appetizer for a 2026 supercycle? Over the last couple of days, I've spent the last few days wading through Wall Street year-enders and a mountain of geopolitical briefings. I've cut out the noise so we can get straight to points you need to know. This video is your arsenal for battling in the gold market. We're answering 3 burning questions. Why is it rallying so hard? Will it crash after the holidays? And for 2026, is gold heading to $5,000 or collapsing back to $3,500? Before we start, standard procedure, let's get the disclaimer out of the way. Everything in this video is just my personal opinion and does not constitute investment advice. Market volatility is extreme right now, so please think independently when making trading decisions and protect your wallet. All right, let's get down to business. Here's the key point. First, we have to understand why gold is rallying with absolutely zero chill this Christmas. This is definitely not your traditional seasonal bounce. There are 3 massive forces colliding behind the scenes. Force number 1, and the most direct trigger. What started as a geopolitical black swan completely off the radar has morphed into a gray rhino. It's a massive, obvious threat charging right at us from the Caribbean. If the situation in the Middle East previously just gave gold a gentle nudge, the crisis erupting this month between the US and Venezuela is like pouring a bucket of gasoline on the fire. According to our latest intel, President Trump has ordered a total and complete oil blockade on Venezuela. And this isn't just talk, the US has deployed the largest naval fleet in South American history to the Caribbean. What does this mean? It's not just diplomatic pressure. The market is interpreting this as a prelude to actual military conflict. There are even rumors that members of Congress have received briefings on an imminent declaration of war. Come on, imagine this. This is happening in the Western Hemisphere. This level of risk has fully triggered gold's safe haven status. Money is panicked, capital is fleeing, Latin American emerging markets like crazy, and flooding into precious metals at any cost. Plus, there's a deeper logic here: energy. Venezuela holds the world's largest oil reserves. The blockade has driven oil prices straight up, reminding the market of the 1979 oil crisis. History rhymes, doesn't it? The 1979 gold super bull run was built on hyperinflation expectations triggered by an energy crisis. Now, rising oil prices are feeding into inflation expectations, which affects real interest rates. Simply put, oil goes up, inflation expectations go up, real rates go down, and gold flies. This isn't just war panic, it's the return of the inflation narrative. Now that we understand the geopolitical powder keg, let's look at the second force. It's a shift in the monetary order that's happening right now, but few truly understand. China and Russia are flying under the radar. Beneath the obvious war risks, the global monetary system is being quietly reconstructed. This is the bedrock supporting the long-term gold bull market. Let me hit you with a shocking stat. Just last month, November 2025, China imported $961 million worth of gold from Russia. That is the highest record in the history of their bilateral trade. What does this tell us? It reveals a profound trend. After being kicked out of the dollar payment system, Russia is using its gold reserves as hard currency to buy goods. Meanwhile, China is aggressively stockpiling gold to shore up its reserves and provide the floor needed to internationalize the yuan. This model of oil for goods, gold for liquidity is effectively building a shadow gold market that bypasses the SWIFT system America's financial controls. Central banks aren't buying gold now just to make their portfolios look pretty. They're buying for survival and trade security. JP Morgan's quant models tell us that for every 100 tons of central bank demand, gold prices rise by 2%. In the first 3 quarters of this year alone, demand hit a staggering 634 tons. At this pace, gold will be pushed to $5,000 an ounce next year. This also means pricing power is shifting from the paper gold markets in New York and London to the physical gold market. It's a historic transfer of power. Next is the third force, the macro policy game, specifically what everyone cares about most, the Fed. Although inflation data keeps jumping around, the market has already locked in expectations for the Fed to open the floodgates in 2026. The current consensus is that the Fed will cut rates 2 more times in 2026, but that's just the baseline. It doesn't even account for how aggressive the new Trump-backed Fed chair might be when they take office next year. This is like injecting steroids into the gold market. Low interest rate environments reduce the opportunity cost of holding gold. More importantly, with the U.S. fiscal deficit expanding and tariff wars pushing up import costs, inflation pressure will likely stay high. In this scenario, real interest rates, nominal rates minus inflation expectations, will drop into negative territory, and for gold, negative real rates are the ultimate comfort zone. So, to summarize the first half, war premiums, de-dollarization, and the Fed pivot. These 3 forces have combined at the end of 2025, pushing gold prices up to the divine level of $4,500. But I know what you care about most. Is this Christmas rally over? Can you still chase it, or should you run for the hills? There are a few danger signals I need to warn you about. Let's look at the downside risks from 3 angles. First, the double-edged sword of seasonality. Historical data shows December is usually a strong month for gold, averaging a 2.6% gain over the last 10 years. But this December, it's up over 8%. It's like an athlete who only needed to run a 100-meter sprint but decided to run a marathon instead. There's a real risk of burnout. Although historically, gold has a January effect driven by peak demand for the Lunar New Year in East Asia, meaning strength often continues into January. But pay attention. After such an extreme surge, early January often sees institutional profit-taking. Especially for fund managers, they've got their year-end bonuses, the annual reports are done, and when they rebalance in early January, liquidity can dry up instantly, triggering massive volatility. So don't think you're safe just because Christmas is over. The days right after the holidays are the most dangerous. Second, a deep dive into the technicals. This is what worries me the most. Pull up the daily chart, and gold is currently building a very classic rising wedge. If you don't know technical analysis, that's fine. I'll explain. It's like a spring. The highs are getting higher and the lows are getting higher, but the range is getting tighter and tighter. In technical analysis, this is usually a bearish reversal pattern. It means the bullish momentum is fading and the buyers just can't push it any higher. Then there's the RSI, Relative Strength Index. The daily RSI is already above 80, which is seriously overbought. Plus, we're seeing typical bearish divergence, meaning the price hit a new high of 4,525, but the RSI high is lower. It's like the car is speeding up, but you've floored the gas pedal and nothing's happening. That is a classic signal that the top is in, and you need to watch out. Third, capital flows. The trade is crowded, but not insane yet. The CFTC positioning report shows speculative net long positions are at historical highs. While this usually hints that buying power is exhausted, in a super trend, high positioning can last a long time. The slightly better news is that ETF inflows started coming back in the second half of 2025, so institutions don't think it's overcrowded yet. This implies that for the long term, there's still dry powder left. Speaking of which, I want to ask you guys, facing these pullback risks, are you preparing to buy the dip, or are you rushing to take profits and run? Let me know your thoughts in the comments. Let's discuss. Now that we've covered the short-term thrill ride, let's look at the bigger picture. In 2026, the world after this super election year, where is gold actually going? There are 2 scenarios here. One is heaven, the other is hell. Let's look at the high probability bull case first. Target $5,000 to $6,000. I'm not making this up. It's the consensus among mainstream Wall Street banks. JP Morgan predicts an average price of $5,055 by Q4 2026, with a long-term view of $6,000. Bank of America has also hiked its target to $5,000. Goldman Sachs is eyeing $4,900. Their logic is rock solid. Besides the geopolitics and central bank buying we just discussed, the core narrative is the U.S. debt trap. As U.S. debt interest payments eat up a larger percentage of GDP, the Fed will be forced to implement yield curve control (YCC), or basically print money to suppress bond yields. What does that lead to? Damaged dollar credibility. When people stop trusting the dollar, gold as the ultimate currency gets repriced. Here's a high-level insight I call the catch-22 dilemma. The market is cornering the Fed. If the Fed keeps rates high to fight inflation, U.S. debt interest payments explode. If they cut rates to save the debt, inflation spirals out of control. See that? No matter what the Fed does, gold wins. It either wins on safety or it wins on inflation hedging. That is the biggest confidence booster for gold bulls. But I have to warn you about the bear case. Although the probability is low, if it happens, it's a disaster. This risk comes from a deflationary crash. If Trump's tariff policies lead to a global trade collapse, or if the U.S. stock market sees an epic bubble burst, the market could face deflationary deleveraging. In this extreme scenario, all assets, including gold, get sold off to raise cash, U.S. dollars. In that case, gold prices could crash to $4,000 or even $3,500. There's another risk: sudden geopolitical de-escalation. If the U.S.-Venezuela conflict suddenly reaches a deal, or if there's a ceasefire in Ukraine, that massive war premium will evaporate instantly, which would also undercut gold prices. Finally, I want to share a deep thought that goes beyond the surface. What we're seeing today is price volatility, but in reality, we are witnessing the changing of an era. When China and Russia start settling oil directly in gold, and when gold's pricing power starts shifting east, it means the dollar's network effect is being broken. Long term, gold might decouple from the dollar and become an independent monetary anchor. This is the most important structural change to watch in 2026. So, while the Christmas gold rally might be taking a breather in terms of price action, deep down in the logic, a much larger capital migration has only just begun. Let's wrap up. Short term, technical divergence signals risk of a pullback after the crazy Christmas rally. Medium term, the Lunar New Year effect is still in play. Pullbacks might be buying opportunities. Long term, the debt trap has no solution. $5,000 is on the table of possibilities. All right, that's it for today's deep dive. Do you think gold can hit $5,000 in 2026? Or will it crash back to $3,500 due to deflation? Drop your price targets in the comments. If you found this video helpful, please smash that like button, subscribe to the Gold TLDR, and hit the notification bell. This is the Gold TLDR. See you in the next video. Bye.